What if you could invest in a shopping mall, an apartment complex, or even a hospital without ever dealing with tenants or maintenance? That's the opportunity REITs offer. Real estate investment trusts allow you to own a slice of income-generating real estate and benefit from regular dividends, all without the hassle of direct ownership. In this video, we'll unpack how REITs work, the types you should know about, and the strategies for using them to diversify and enhance your portfolio. We'll also look at the risks, how market trends impact REITs, and how to pick the right ones. If you're serious about building a solid, income-focused portfolio, keep watching. There's a lot to cover. REITs let you invest in real estate without owning property. Think of them as companies that own or finance properties that generate income like apartments, malls, or hospitals. They pool money from investors to buy and manage these properties. The best part? They have to give at least 90% of their profits back to investors as dividends. This makes them a popular choice for people looking for steady income. But how do they work, and what should you know before investing? Let's break it down. I'm going to run through the following topics. How do REITs turn buildings into cash for investors? It's a smart business model that's worth understanding. REITs earn money in two main ways. Equity REITs own properties like shopping centres and office buildings. They make money by collecting rent from tenants. Mortgage REITs, on the other hand, don't own property but provide loans to property owners and developers. They make money from the interest on these loans. Because REITs must pay out 90% of their income as dividends, they are known for providing steady, regular payments to investors. However, since they pay out so much, they often borrow money to fund new projects, which can be risky. Knowing how a REIT makes its money, whether through rent or interest, can help you decide if it fits your investment goals. Not all REITs are the same. Some focus on malls, others on hospitals. So which one should you consider? REITs come in different types, each focused on a specific sector. Retail REITs own properties like shopping malls and are affected by consumer spending trends. Residential REITs focus on rental apartments or single-family homes and are often stable because people always need places to live. Healthcare REITs invest in properties like hospitals and nursing homes, which depend on the aging population. Office REITs focus on office buildings and rely on companies leasing space. Then there are mortgage REITs, which make money from real estate loans rather than owning the properties. Investors can buy shares in these REITs directly on the stock market, or invest in REIT mutual funds or ETFs to diversify their holdings. Knowing which type suits your risk tolerance and market outlook is crucial. REITs sound great with their regular income, but what about the risks? Let's look at the full picture. The biggest benefit of investing in REITs is their potential for steady income, because they pay high dividends. They're often used to balance a portfolio and provide cash flow. They also offer diversification because they allow you to invest in various types of properties without owning them directly. But there are risks too. REITs are sensitive to interest rates. When rates go up, REIT shares often go down. Additionally, dividends from REITs are taxed as regular income, which can be higher than capital gains taxes. Also, some sectors, like retail, can be more volatile due to changing consumer habits. It's important to research and choose REITs carefully, looking at factors like management quality, property types, and financial stability. How have REITs performed over time? The answer shows why they're a favourite among smart investors. Over the years, REITs have generally performed well, providing both income and growth. They've often outpaced other investments, like bonds and even some stocks. During good economic times, they benefit from higher property values and rent prices. However, in downturns, their performance can be mixed. For instance, office REITs might struggle if businesses cut back on office space, while healthcare REITs might stay steady due to ongoing demand. This mix of income and growth potential is what makes REITs appealing, but it also means understanding the economic cycle and being prepared for some ups and downs. Choosing a REIT isn't just about chasing the highest dividend, there's a strategy to it. When selecting a REIT, focus on the quality of the properties it owns, the strength of its balance sheet, and the experience of its management team. A good REIT has a mix of stable properties and growth opportunities. Key metrics like net asset value, NAV, and funds from operations, FFO, help you understand a REIT's value and cash flow. A REIT with too much debt might struggle in a downturn, or if interest rates rise. Diversifying across different types of REITs can also reduce risk. For example, combining a stable residential REIT with a more aggressive healthcare REIT can provide both steady income and growth potential. REIT ETFs or mutual funds can offer a simpler way to diversify, spreading your investment across many REITs. Not all REIT sectors are equally attractive. Office REITs face challenges due to the ongoing work-from-home trend, and retail REITs are pressured by the growth of online shopping. Instead, consider industrial REITs like Prologis, which benefits from e-commerce growth, or residential REITs like Avalon Bay, Equity Residential, and Essex Property Trust, which thrive as housing demand rises. Sun Communities focuses on manufactured homes, and Invitation Homes benefits as interest rates decline. Self-storage REITs like Extra Space Storage provide stability. For specialised options, Ventas and Healthpeak are strong in healthcare, Waiheauser in timberland, Crown Castle in telecom infrastructure, Equinix in data centres, and Vici Properties in gaming. To trade these REITs, a simple trend-following strategy can be effective. Here's a suggested approach. Use a 200-day exponential moving average EMA to show the long-term trend. Buy when the price is above the EMA and sell when it falls below. Apply the MACD, moving average convergence divergence, as a confirmation for entry only. You can also use an economic filter. Watch the Federal Reserve's interest rate policy. If the Fed rate trends upward again, exit REIT positions. Rising rates often negatively affect REITs due to higher borrowing costs and reduced appeal compared to other income-generating investments. Combining these technical and economic factors can help manage risks and capture growth opportunities in REIT trading. To refine this REIT trading strategy, check price to earnings, PE, price to FFO, funds from operations, and price to NAV, net asset value ratios. Avoid REITs with excessive valuations relative to their historical averages or sector peers to minimize downside risk. Also look at earnings growth rates. Ensure REITs have consistent earnings or FFO growth. Higher growth rates indicate strong management, desirable assets, or helpful market positioning. Combining technical indicators, EMA, MACD, with economic filters, Fed rate trends, and fundamental analysis, valuation and growth, can enhance decision-making, reducing risks while targeting potential gains. Are REITs a smart addition to your investment portfolio? Let's consider the numbers. REITs can offer strong diversification benefits. Over the last 10 years, their correlation with the Nasdaq is just 0.47, and with the S&P 500, it's 0.66. This means REITs don't move in lockstep with the main stock indices, helping to smooth out your portfolio. Since 1972, REITs have had an average annual return of 12.7%, slightly higher than the S&P 500's 12.3%, including dividends. This combination of high returns and low correlation with stocks makes REITs a compelling option for those looking to balance growth and risk. If you enjoyed or learned something from this video, please take a look at my Patreon channel, linked below, and subscribe so YouTube notifies you of future videos. On the top left, I have a video showing how I make 20% per year. Thanks for watching.